First Republic getting hammered in the pre-market. Equity futures negative 0.5%. Live from New York City. Good morning. Good morning. We're softer here going into the open. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with Jonathan Ferro.
Live from New York, coming up. First Republic results sending the stock much lower. President Biden finally announcing his re-election bid and looking ahead to big tech reporting after the close. We begin with the big issue, some cracks in the calm.
We're still relatively cautious.
We're always looking towards what the next shoe to drop will be.
And what's happening underneath on some of the things because of these regional banks.
For First Republic,
they're going to reduce the workforce 20 to 25%. That makes sense.
they have really struggled clearly for the quarter.
Many of these deposits have flowed to the large banks. Clearly, if you continue to have a lot of outflows,
And they need to do something. They either need to shrink the balance sheet or they need to find a buyer.
When you look at, again, the regulatory environment for the regionals, it's evolving.
In the U.S., it's not just about one bank. It's about actually a whole type or a whole category of banks.
You are starting to see an economic slowdown.
The real question is credit really going to be much tighter?
I think that is something that the Fed needs to watch carefully.
There's still some pain to come, we think.
Some pain to come. Let's start the conversation with Aberdeen's Luke Hickmore, Keith Lerner of Truist. Gents, great to catch up with you going into the opening bow. Keith, your line, you nailed it. Are things resilient or complacent?
Yeah, well, great to be with you, Jonathan. I mean, that is the question, right? If you look at the headline, the popular averages, I think the answer would be resilient because we're up 8% this year. But as you peel back the onion and you look underneath the surface, I think you see less resiliency. In fact, the average stock this year is up, 2 or 3%. We all know the story. The big cap tech names are up like 20% on average. And then as you look if you think of this as, there's a lot of debate, are we in a new bull market or not? In a new bull market, you typically don't see small caps making relative lows or financials leading to the downside. So overall, we remain defensive. We think the risk reward is less attractive at these levels today, and we're being patient.
Luke, this builds on a conversation we've had throughout the whole of the morning so far. It's whether this tight, well-behaved trading range of 3,800 to 4,200 on the S&P so far year to date, the minimal moves we've seen last week, muted price action month to date, masks something more sinister developing. Where'd you come down on that particular debate at the moment, Luke?
I kind of agree with Keith. I'm not sure it's an onion, though. I think there's an issue here that inflation's going to be coming down. It's going to pull down revenues. And I don't think we've really seen people adjust their EPS forecast enough for the change in the environment that we're going to see for the rest of the year. I think equities are too high here.
Is that for the tech story specifically, Luke?
I guess tech might actually get a little bit of support. If you think of tech as a long duration equity, thinking in bond speak like I do, and yields are coming down and interest rates will fall late this year, early next, maybe some support. But, they're going to get carried around with the rest of equity markets as well, which are just too high at the moment to support where we see earnings going.
Google, Microsoft after the close onto Wednesday, Meta, Thursday, Amazon next week, Apple on May 4th. All of this, a big, big chunk of the market cap of the S&P 500 over the next week or so. Keith Lerner, a question I keep leaning on over the last 24 hours or so. Keith, the moves we've had year to date, will they be validated by the numbers from these companies?
Yeah. Well, I think, Jonathan, Louis Rukeyser said, don't make a prediction where you could be wrong in 24 hours. But even with that, I'll still take a guess. I think the earnings will come in relatively well. I think the challenge for this overall market is, tech is the main reason why this market's up this year. And actually, if you look at the S&P 500, only about 30% of stocks within the S&P 500 are actually being the index, and that's tech-driven. But now you're at about a 30% premium for the technology sector. A lot of good news is priced in. We still expect them to outperform on a relative basis, but we're not overly excited about the group on its own, and that's why our overall market view is somewhat muted. Because let's talk about tech. The technology sector itself. Two stocks, Microsoft and Apple, account for over 50% of that index and about 14 to 15% of the S&P itself. They're both trading around the 26 multiple at the high end of the historical range. So I think on a relative basis, they'll do fine. But I don't know how much upside there is in tech to really drag this market higher, given the one that we've seen year to date already.
Year to date, Meta up 77%, Microsoft up 17% there, Alphabet, Amazon in and around 20% higher for the year so far. Let's talk about something that's been absolutely battered year to date. Let's talk about the financials. First Republic right now in the pre-market down 26%. Kelly Lyons has more. Hey, Kaylee.
Yeah, John, this is said to be the biggest drop in over a month. And really, this is all about deposits. In results, the bank posted yesterday, we saw a 41% drop in deposits down to $104 billion at the end of the first quarter. That was well short of analyst expectations and signifies a $72 billion drop in deposits quarter over quarter. That's even with a $30 billion deposit infusion from larger banks last month to try to stabilize the bank. Clearly, though, this bank is still struggling. Aside from the deposit picture, it had a 19% drop in net interest income. It's getting squeezed by higher funding costs. And so the bank is looking to make some changes. They are going to cut 20 to 25% of their workforce in the current period, try to moderate loan volumes as well, reduce the size of the balance sheet. And they also said on a call in which they took no questions, mind you, in this earnings call, that they are exploring strategic options. Now, Bloomberg has previously reported they've considered a sale of the entire bank, but its sizable unrealized losses have caused some buyers to balk at the prospect. So the future of this bank in many ways remains uncertain. In the meantime, though, the shares just getting put under more intense pressure. Already it was down 87% year to date through yesterday's close. Those losses, of course, building in a big way this morning. This was a $121 stock at the start of this year. Currently in pre-market trading, we're south of $12, John.
Back to 11. Kaylee, thank you. 11 on First Republic. I think Citi came out with a call earlier this morning to cut this stock to a sell with a price target of 11. We're there right now. Look at the deposit numbers. Kelly went through them. I'll go through them again. Analysts were looking for 137 billion. They got 104.5. These numbers, even with 30 billion coming from some big banks parking some big money at this institution. The good news is that deposits apparently have stabilized since the quarter ended. The bad news, Keith, when someone holds an earnings call after a month like the month they had, and they don't take questions, where does that leave you thinking about this situation?
Well, I think in general, when you don't have an earnings call, people think of the worst, whether that's the reality or not. But I think the big picture is we actually downgraded financials last Friday based on the bounce. We had a nice bounce off the low, about 7%. And our view is, first of all, financials tend to be a leader into an economic downturn and out of the economic downturn. In our view, financials, the risk reward is unfavorable. You have a slowing economy. You have the funding costs obviously going higher. So earnings are going to be pressured for some time. So we think in general, at best, they're likely dead money, but likely to underperform the overall market. And I think the bigger picture is the whole thing about the deposit flows and so forth, that seems to have stabilized. I think the next step is that we're going to see the pullback in credit lead to a weaker economy, which will eventually work into those lower earnings that we expect in the back half of the year.
Can we avoid the credit crunch? That's still the open debate. Luke, I'm looking at some of your notes that you've put out. You are firmly in the US recession camp. Luke, why is that?
I think exactly this point about a credit crunch is going on. It's reducing inflation, those falling revenue numbers, lower nominal growth, and still consumers suffering from wages just not keeping up with inflation over the last 3-4 years, and pushing and pushing and pushing. So, yeah, I agree. Margins for banks under pressure, margins for corporates under pressure as we go through the end of this year. It's really hard for me to see how all of that happens without a recession in the US. And let's be honest, it's what the Fed's been pushing rates up to achieve. Every hiking cycle should end and normally ends in a recession. So I think it will do again.
We need the bond market call then, Luke. That's the missing piece of this. I've got a 10-year right now lower by 7 basis points to 342 off the back of the Philly Fed data earlier this morning, weak. Dallas Fed manufacturing data yesterday, soft. You must have a pretty bullish call on the long end of the curve. Is that right?
I think actually we probably prefer the 5-year part of the curve.
Okay.
I don't think it'll matter too much, Jonathan. We've never been longer. And right now, it feels like a great place to be. Long duration, buy assets where you can find them in credit markets that are good quality, investment-grade assets, maybe move away from some of the lower tier of banking bonds for sure. But, picking up 5-year US Treasuries, 10-year US Treasuries, I think that will pay off handsomely for you through here to the end of the year.
What kind of numbers have you got in mind? We're in and around 350 right now on the 5-year and the 10-year for that matter too.
I think we could touch 3 again by year end. And as we go into next year, I really wouldn't be too surprised to see a 2 handle come back into the US 10-year.
Wow. 2s on 10s all over again. Keith, when you hear those kind of numbers, what do you think about that?
Well, we've been overweight fixed income. We're keeping it simple on focusing on high quality. We actually went long duration when the 10-year was just above 4%. We still think if the economy is going to weaken, we think that bonds will continue to perform well. We would be looking if to add new duration or extend duration at this point. We would prefer to have something closer to 375. But the big story is that we still think that the peak of this cycle is likely in for interest rates, and that's a reflection of slowing inflation, but also the slowing economic growth we expect in the back half of the year. There's also a pretty big short position in treasuries right now, and that's betting that rates will move higher, and I think some of that will have to be covered as well.
Keith, we'll carry on talking about this. You're going to stick with us alongside Luke Hickmore. Looking forward to that conversation on banks. We'll catch up with Manus Cranny of UBS, a little bit later on. If you want the other side of the bond trade, that short position Keith described, don't miss the conversation in about 20 minutes with Katie Kaminsky, who is on that side of the trade, short bonds, thinks inflation is going to be sticky for longer. We'll get the other view in just a moment. Equities down about 0.5% on the S&P 500 with some movers. Here's Abby.
John, and the Russell 2000 is underperforming, down more than 1%. That has everything to do with First Republic. Let's take another look at these shares, absolutely plunging, down 25%, with deposits down 41%. Plus, as Kayleigh was talking about, lots of changes coming, including workforce cuts, as the company explores strategic options. Turning to some winners on the day, though, GM, these shares are higher. The company has raised their outlook as demand comes in very strong amid solid pricing for their vehicles. 3M cutting 6,000 jobs to save another $900 million in a broad restructuring. They also beat top and bottom, the stock off of its highs, but still up. McDonald's climbing by about 1%. Sales topped estimates as fast food diners continue to pay up. And a similar story for Pepsi. They have raised their outlooks as consumers look past rising prices. They put up a solid top and bottom line as well. Those shares are higher, John.
Abby, thank you. Coming up, the UBS CEO with a big challenge ahead.
The only thing I can say is that we will take our time to make decisions based on facts and not based on emotions. And I'm sure it's going to be a good transaction.
Sergio Ermotti on combining UBS and Credit Suisse. That conversation up next.
At times of distress in the market, generally the first quarter was very challenging. We still saw clients looking at UBS as a safe haven, and the inflows were coming in from all regions and from different sources. And in that sense, we are very pleased that, particularly also after the announcement of the transaction of the acquisition of Credit Suisse, we still saw inflows coming into our bank. So a sign of confidence of our clients.
That was UBS CEO Sergio Ermotti speaking to Bloomberg's Manus Cranny a little bit earlier on. The Swiss lender reporting its weakest quarterly profit in more than 3 years, and a disappointing outlook for its wealth unit too. Wealthy clients are turning more risk averse. Let's head over to Manus Cranny over in Zurich. Not all bad, Manus. A crazy quarter though for this company. Let's put some numbers on it.
So when you look at the numbers, you go, wow, net income down by over 50%. Pause. 15-year-old litigation issue, mortgage-backed securities. Yes, you've talked about them. You thought you were done. Looks like they're batting that one into the ground. So that's dead. It comes to lending, a little bit weak. Net interest income, pumping away on gas, but it might run out of a bit of puff. The issue here is the net new money. Suddenly we're back on that trade again. It's the whole deposit narrative of March. $28 billion came in. $7 billion came in the last 10 days of March after the deal closed. Why was the wheelbarrow not fuller in terms of bringing in net new money from Credit Suisse. Diversification. I'll nip up to Frankfurt overnight, Jonathan. We'll find out where the funds flowed into Germany. The US, you had your very own special banking liquidity, SVB, First Republic crisis, and $8 billion of net new money came from the Americas. So the flow show, Jonathan, is, I think, part of the reason why somebody panicked a little bit this morning, or there was a nervousness and a skittishness, and they hit the sell button, traded down 5%. We've scooped it all the way back up, because I know the math was discomforting for Tom a little bit earlier on, and I'll make it much simpler. There's a truckload of buffer to play with before this CS-UBS trade dents anything into negative territory. I won't give you the math again. You know how it goes.
Well, Manus, let's go beyond the math and talk about the emotion. Obviously, Sergio Demotti doesn't want to talk about emotions, but you've known the guy a long, long time. It was surprising to many that perhaps he would come back. But when you really think about it, it makes a lot of sense. Did you go to that piece of the conversation about why he came back, what brought him back?
You could tell he arrived into that banking hall this morning. We had a sort of a brief sort of private moment together. We haven't been together for a couple of years. We used to get together for 9 years in a row. This is a man with steely focus. He was able to button his jacket. That was a bit of a war game, on the seat. Or Motti was trim, slick, focused. There were moments of just steely execution. The best line, however, is people tell me you're going to have to sell part of this Swiss National Bank, because of the angst and the social discomfort here. He said, yes, I've met a lot of people that seem to know how they run Swiss banking. He said, basically, we're not going to be hurried. He's not going to be hurried. There's a blueprint. It's a UBS blueprint. I suppose when you get a call like that, Jonathan, it just must be one of those moments. I said, are you back in your old office? And he looked at me and he went, yeah. How does that feel? I said, it feels good. But there was a humility in Motti. I think he almost sees it as partly his responsibility now to deliver for the country, to deliver against the social angst. I know you think maybe I'm away off now on a sunbeam, but there is a sense of purpose, of dedication to the country and a mission in Motti that I hadn't seen in the previous 8 years. He's been out for 2 years across the road running a major insurance company. This man is bringing people back around him that he knows, that he trusts, that can deliver and can execute. Is Tom Narratil coming back? We don't know. This is a man that's gathering the forces around him, because this is going to be one monumental creation of a Goliath that is going to be a colossus of Switzerland and of the landscape of banking and asset management. Larry Fink and Jamie Dimon, watch out.
Hey, Manus, world-class coverage over the last 24 hours. Thank you, sir. Manus Cranny from Zurich, Switzerland, on Credit Suisse yesterday, UBS this morning. Back with us for a final thought, Luke Hickmore, Keith Lerner. Luke, sometimes you've got two decisions. You can sell into strength or buy into weakness. For the financial specifically, where are you at?
In credit, we continue to buy, but we're going up in quality. In equity, I would sell into strength.
Why is that, Luke?
I think those margins are going to come under increasing pressure. Earnings are going to be hard to come by. The balance sheet strength is not a story the market's focused on. And we haven't seen the last, I suspect, of deposits changing hands.
Luke, you separated it between equity and bonds. We used to talk about something in between, CoCos, contingent convertibles, AT1s. Now, going into this mess, Luke, you actually pulled back on that. What was it that you saw that made you do so? And have you stayed a little bit more risk-averse around those securities?
I can't say I was worried about Credit Suisse. That would be a brilliant story, but I wasn't. We just saw that the market was overpricing a continuing Goldilocks scenario forever. And really, AT1 CoCos reflect all of that. And they were just getting too expensive. So we reduced quite significantly before Credit Suisse went, and then we cut hard into that post-Credit Suisse as well. And we'll probably stay where we are in kind of 5-6% exposure in AT1 for our more unconstrained funds right now, because you're still getting a really nice yield off them. But, they're national champions. They are rock solid institutions.
When we saw this mess playing out in Europe over that weekend, Switzerland specifically, we all wondered whether it would upset the trade, Europe, overweight Europe versus, say, the United States. That trade has played out in a monster way on the European side. Just this massive rally since the end of September when euro-dollar bottomed and the dollar peaked. You've just seen equities rip on the Euro Stoxx 50. A lot of people trying to consider now, Keith Lerner, when to close that trade. Marko Kolanovic at JP Morgan, Mislav Matejka writing recently, when to close the preference for Europe over the US. They answer, Q1 results still to be better, but don't extrapolate. It might become increasingly difficult for Europe to keep beating the United States. Keith, they go one step further over at B of A. Monetary policy has been tightened by the sharpest pace in 40 years. They go on to say we expect this to lead to recessionary growth conditions over the coming months. Keith, how do you feel about that trade at the moment? It's been really interesting to me to see within the United States tech outperform. But with that, you'd expect the US to outperform Europe, and that's not actually what's materialised, Keith. Would you push back against that trade? Do you expect that gap to close?
Well, I do think that the gap will close. If you look historically, when you go into a global slowdown, the U.S. tends to outperform. But Jonathan, you made a great point. I mean, normally technology is the main factor between the U.S. and international. Tech is doing great. But what's also notable is those European banks are outperforming the U.S. banks by about 30% over the last several months. And they are benefiting from this move out of zero interest rate policy, and they're still relatively cheap. So what we did earlier this year, we actually increased developed international one notch, but it's still underweight. And at this point, we're not looking to increase that. But I will say, I think the European banks are key to watch forward as you're thinking about this trade.
Just hearing more and more pushback against that trade over the last few days. Luke Hickmore, Keith Lerner, to the two of you, thank you. A range of views on this market next week. This week gets bigger with the earnings from big tech, but on to next week. Apple earnings on May 4th, May 3rd, the Federal Reserve, May 4th, Apple earnings and the ECB, and then on May 5th, which I believe is the Friday, payrolls just around the corner. Your equity market right now, negative 0.5%. Coming up the morning calls and later, bracing for a bond sell-off. Why Katie Kaminsky of Alpha Simplex thinks higher for longer inflation could fuel another bond rout. That conversation just a few minutes away. Five minutes away from the opening bow, down about 0.5% on both the S&P and on the Nasdaq. That's the price action. Let's get you some morning calls. First up, Citi upgrading Squarespace to buy, $40 price target, citing an improving outlook for growth. That stock positive 7.5%. Here's one call for you. Janie Montgomery Scott downgrading First Republic to sell, growing increasingly concerned after the bank's earnings report. We're down there by 24%. And finally, Credit Suisse cutting its Amazon price target down to 140, expecting ongoing cyclical headwinds to weigh on Thursday's quarterly results. We're softer there by about 1%. Up next, Alphabet, Microsoft reporting after the closing bell. That conversation with Katie Kaminsky of Alpha Simplex. 24 seconds away from the opening bow this morning. Good morning to you all. Just about putting together some back-to-back gains on the S&P over the last couple of days. Right now, negative 0.5% on the S&P 500. On the Nasdaq, we're down about 0.5%. Bit softer, lighter, lower going into a big earnings afternoon after the close a little bit later with Google and Microsoft to kick things off for Silicon Valley. There's the opening bell. That kicks off the trading session. Here's the bond market. Yields lower by 5 basis points, 343.72. Just some of these regional Fed indicators weighing on this bond market, fueling a bit of a rally over the last couple of days. Dallas Fed yesterday, Philly Fed this morning. We're down 5 basis points on a 10-year maturity. Just to pick on the 2-year, we're down 5 basis points there, just about holding on to a 4 handle on 2s. North of 4% all through last week, and just about this morning at 4.04% on a 2-year. In the FX market, touch of dollar strength, euro weakness, holding on to 110, euro dollar 110.14. We're negative 1/3%. About 30 seconds into the session, we're down here on the S&P 500 by 0.4%. On the Nasdaq by 0.6. If you want to see some major price action, though, check out this name. First Republic, recording its biggest intraday drop in more than a month after reporting a massive decline in deposits. The CFO said this: with the closure of several banks in March, we experienced unprecedented deposit outflows. We're working to restructure our balance sheet, reduce our expenses and short-term borrowings. Katie Lyons, this is a difficult morning for that bank.
It is. The stock dropping 25% in the first few minutes of trading here, but they, of course, reported an even larger deposit drop than that, 41% in the first quarter. Deposits falling to just $104 billion. The street was looking for $137 billion. So, yes, it was a big miss. Also compounded by the fact that that was even with a $30 billion deposit inflow from larger banks who were attempting to stabilize First Republic last month. Now, as for the other highlights, they have said that deposits have stabilized to this point. That doesn't necessarily seem to be shoring up confidence this morning. And as you said, trying to reduce the size of its balance sheet, moderate loan volumes, and cut costs by reducing as much as 25% of its workforce, as well as exploring strategic options. So this is a bank clearly still struggling in the aftermath of the SVB and Signature Bank failures and the crisis of confidence in regional banks. However, it seems to be suffering even worse from that crisis of confidence, which perhaps is exacerbated by the fact that executives didn't take any questions on the earnings call amid that ongoing crisis. First Republic now down 90% year to date. Regional banks more largely still down about 29% in 2023. Of course, both of those dramatically underperforming the wider financial sector. But First Republic, John, it's an ugly chart to look at.
It's a tough morning. It's been a tough year, that's for sure. Kelly, thanks for that. I talked about some of the research coming from the South Side and mentioned specifically that note from Jenny Montgomery Scott. Here it is. They downgrade the shares to a sell. They write this. Pretty punishing, brutal language, to be honest with you. First Republic results were far worse than we expected, and we believe the company, here's the line, needs to pull off the mother of all pivots to survive. That stock is down 27% in early trading. Another bank reporting across the other side of the Atlantic, we mentioned UBS, they're actually paring their declines right now after falling more than 5% a little bit earlier in Swiss trading. The Swiss lender writing in a statement this: while concerns about the stability of banks have abated, they have not gone away. As a result, client activity levels could remain subdued in the second quarter of 2023. Shanali, great to catch up with you, because when you put this all together, we might have avoided the worst of it for some of these names, but ultimately it's going to be a challenging year ahead for them still.
It certainly is. But remember, the reason they're paring their gains in the market, John, is because you have UBS coming in with the mother of all deals here. They're about to have the biggest charge here, a negative goodwill charge of more than 51 billion Swiss francs because they bought Credit Suisse so cheaply. But listen, the numbers themselves, I think you have to notice the pressure on the numbers here, that global wealth management revenue coming in below expectations, and even on the investment banking side, equities coming in below expectations. It tells you two things. One, even the world's wealthy are not immune to tough times. Even though net new money is up, the revenue, again, because client activity is down, is estimates. I'm sorry about that. But the equities trading, the reason it matters, remember, we're one prime broker short in the world now without Credit Suisse. So UBS, as it caters to that investment banking business, can they gain share? This is a bank that has avoided risk very significantly since the last financial crisis. We're going into tougher times. Can they compete with the European banks as well as the U.S. banks as they integrate another behemoth? I think that is the big question as we look to years ahead for these two firms.
They're certainly going to try. Shanali, wonderful coverage, not just this morning, but over the last few weeks as well on the financials, the last few months for that matter. That's UBS. Let's talk about UPS. That stock is down in early trading by almost 8%. They're projecting annual sales to come in at the low end of its guidance as demand continues to decline. Here's the update from the chief executive, the CEO, writing this. A deceleration in US retail sales resulted in lower volume than we anticipated, and we faced ongoing demand weakness in Asia. We expect volume to remain under pressure. Abby, not looking good for them this morning.
Not looking good at all. In fact, we're looking at the worst day right now for UPS going back to October of 2020. As you mentioned, the stock sliding by almost 8%. The quarter that they just reported basically in line, a little bit of a miss for sales, but it has everything to do with guiding toward the bottom of that outlook, as you were just mentioning, the company talking about the weakness that they're seeing in demand. So what goes up must come down. We have the pandemic trends, some of them reversing, lots of e-commerce back then, maybe less so now. They're talking about weak U.S. retail sales and that they're seeing weaker demand. So again, they're at the lower end of their guidance for sales. In the quarter that just was, while on the surface basically in line, operating profit margins did fall 11% from 14%, so maybe not managing costs all that well. In addition, while the domestic revenue per package rose by nearly 5%, the parcel volume, not surprisingly, down 5%. They have a looming possibility of a strike strike. They have to negotiate a contract of 330,000 workers by the end of the year. The stock had been, wow, what a chart there. The stock had been up more than 10%, now just up 3.4%. I wouldn't say it was priced to perfection before, but maybe you could say that, John, given the fact that now it's almost even on the year, really eating into that massive gain that it had.
Getting punished. Stock's down 8% on UPS. Here's a stock up almost 8%. It's positive 7.5% right now. Spotify rising after posting double-digit subscriber growth. Ed Ludlow joins us now on the West Coast for more. Morning, Ed.
Yeah, good morning, Jonathan. Subscribers coming in at 210 million, 15% gain above street expectations. Monthly active users in at 515 million, breaching that 500 million mark, again above expectations. Real momentum in the quarter. A narrower or shallower than expected loss of $172 million. The only area or metric where they missed was on the top line. But actually, if you read across the sell side reaction this morning, the aggregate of all of the metric beats make that sales growth an afterthought. They also gave a pretty bullish outlook for the current fiscal second quarter, where they did state that revenue would grow to 3.2 billion euros. A lot of momentum around podcasts, a lot of momentum and profitability profile around music, especially at a time where like Apple Music and some of their peers, they're raising prices. So they were able to grow their subscriber base, their monthly active user base, and then forecast that that will continue sequentially. That's got a lot of the street very positive, up more than 8%, on track for his biggest gain since the end of January, Jonathan.
Ed, you mentioned Apple. Next week, Apple earnings. Let's talk about how busy you and Caroline Hyde are going to be over the next couple of days. Later, Google and Microsoft. Tomorrow, Meta. Thursday, Amazon. Give us the guide, Ed. What are you looking for a little bit later?
Yeah, look, the broad theme is that, you know, on an EPS basis, we're going to see earnings have their biggest drop since 2009. Across information technology on the S&P 500, a pullback of 15%. Those names on your screen, broadly what they're saying is we're worried about the bread and butter businesses, the core businesses, and how they are going to fare. In Microsoft's case, cloud and enterprise software, Alphabet search. What we're looking for is, A, what was the action of layoffs and cost cuts to the bottom line in terms of margin protection? And then B, are there some saving graces? So you take Alphabet as an example. We're worried about that core search business, but does Google Cloud then step up and save the day in a way that AWS has done for Amazon in the past?
Big effort for the Bloomberg technology team. Coverage starts in a couple of hours on Bloomberg TV. Looking forward to it, Ed, alongside Caroline Hyde. The broader market right now, 9 minutes into the session, we're negative 0.4% on the S&P 500. Earlier on this hour, you heard from Luke Hickmore and others from Aberdeen talking about the potential for yields being lower. Let's talk about the potential for yields being higher. Katie Kaminsky of Alpha Simplex going short bonds and saying this: we may see a risk of a strong curve steepening and sell-off in bonds later this year as investors face the realities of higher inflation for longer. Katie Kaminsky joins us right now. Katie, wonderful to catch up with you. I've been looking forward to this all morning. Let's start there. The argument from here for higher yields, Katie, what is it?
Well, if you have to think about inflation tolerance, so if the Fed actually pauses and inflation is higher than target, just in basic mechanics, that affects long-term cash flows. If that's the case, at some point, people might start to realize that longer-term debt is not worth as much as what it is today if we don't have cuts quickly. And I think that's something that people are underestimating because they're just hoping that everything's just going to stop and go back to normal. And I think that they're ignoring the risks in the bond market.
Being actively short is very different to just not being long. Now, Katie, I wonder if these massive swings over the last few months make it difficult being actively short this market. How do you go about doing that?
Yes, this is a good point. I mean, let's just be honest. We saw one of the biggest shocks that we've seen and one of the biggest bites for short positioning earlier in March when you had that flight to safety. But on the other hand, we might be ignoring the long end of the curve, which could have potential to move if we see inflation for a longer period of time. And I think most investors are hopeful that inflation will come down, hopeful that a Fed pause will be nice to the equity markets and that will waver this. But I think where you'll see the catalyst of problems is when you actually see the fixed income markets have trouble later in the year, which could predate any sort of equity drawdown.
So, Casey, let's assume you're right. Let's work with that. High yields and do some scenario analysis through other asset classes. Let's push it through equities first. What would you expect to happen with equity leadership off the back of the call that you're making in the bond market?
Well, so first we're going to see a steepening of the yield curve. That means that people lose confidence in the valuation of long-term cash flows, which then affects discount rates, which kind of shows that lending is even more expensive. That's going to put tightening on equity markets, which would cause a lot of problems. On the other hand, it might create the desired results that the Fed is looking for to actually de-inflate assets and then put us in the right place. Unfortunately, that's not a very fun scenario for most investors. If we actually see a drawdown in both equities and fixed income, that's what we had last year, and it's not a very pleasant experience for the 60-40.
Just to recap some of the price action right now, First Republic down 29%, record low on the stock. Brutal stuff. Is trading in and around 11 off the back of earnings yesterday. Deposits much lower than anticipated. The idea that things have stabilized since the first quarter, not enough to encourage any gains in this stock this morning. They had an earnings call yesterday, no questions. The stock is down by close to 30% and struggling to bounce. Katie, how do you think about the financials and how they're involved in the call that you're making currently?
Well, let's take a look at what happened. So when we go back to what happened in March, we really saw people start to realize time value of money has changed. The value of bonds, cash flows, my deposits, they need to be different in this environment with higher inflation. And now that I have attractive rates, maybe I'll start actually thinking about shifting money around. And so if you look at what's happened in the banking crisis, you're going to see more of this type of problem as people deal with duration mismatch, cash management, in a world with much higher rates and an inverted yield curve.
Is this a time to buy gold?
Good question. Gold has really rallied on this move, and it is one of the safe haven assets that's actually moved when the dollar didn't move like a safe haven asset. So it could actually be a time where precious metals might be one of the few trends. It's one of the few signals that we're seeing from a technical perspective that precious metals are something that people are buying because they may say, what else do you buy in this situation?
Well, Casey, what would you advocate for when you take exposure to precious metals? Would you do it directly? Would you do it through miners? What would you do?
Well, so you can take direct exposure via ETFs or via futures. There are also indices which investors can take exposure in as well. If they think that they don't want to just park cash, that's something that investors can actually look into for these days with ETFs in particular.
Katie, just out of interest, when was the last time you advocated for a position in gold?
I think pretty often when there's some sort of safe haven trade, gold has been interesting. I mean, metals, to be honest, have been more of a base metals trade in the last 2 or 3 years. So it's been the first time that we've actually started talking about gold, platinum, palladium. It's because those assets were less active in an inflation environment, but more active in a recession, in a recessionary question environment.
Through 2K in the last couple of weeks, backed away since then, just south of that number right now. Katie, wonderful to get your perspective on things. Katie Kaminsky there of Alpha Simplex taking the other side of that trade. Luke Hickmore was talking about lower yields. Katie's talking about the prospect of higher yields and a range of outcomes more broadly cross-asset for that. The equity market, first of all, we're down about a third of 1%. On the NASDAQ, negative 0.4%. Outside of that, in the bond market right now, yields lower by 7 basis points. Dallas Fed manufacturing yesterday softer. Philly Fed, that number this morning came in softer too. So bonds are rallying. Outside of the bond market, just the one that gets your attention, First Republic, it's pretty tough. Stock is down by 29%. And moments ago, a record low. Coming up, President Biden making his 2024 run official.
Let's finish this job. I know we can. Because this is the United States of America. There's nothing, simply nothing we cannot do if we do it together.
That conversation up next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, PepsiCo CFO Hugh Johnson. That conversation at 11:30 a.m. Eastern, 4:30 p.m. in London. This is Bloomberg.
The question we're facing is whether in the years ahead we have more freedom or less freedom, more rights or fewer. I know what I want the answer to be, and I think you do too. This is not a time to be complacent. That's why I'm running for re-election.
Finally, the President of the United States officially launching his re-election bid, setting up a possible rematch against GOP frontrunner Donald Trump. This as Biden remains locked in a standoff with Speaker McCarthy over the debt ceiling. Bloomberg reporting McCarthy's bill will hit the floor this week under a rule that doesn't allow amendments, despite falling short of the Republican support needed for it to pass. Team coverage begins right now with Anne-Marie in D.C. alongside Katie Lyons. I want to start with you, AMH. The latest, finally, he got there. I think we've been waiting for this official announcement from the President of the United States for the best part of 6 months.
Yeah, Jonathan, if there's any confusion, Joe Biden is seeking re-election and he's running for office in 2024. He's going to be the undisputed candidate, right? He's the President of the United States, and this is just him making it official. But with a highly produced video, this isn't a campaign event. But what it does do is it sets Biden up to now start fundraising. He just also filed in the last hour FEC paperwork, the Federal Election Commission, so he can start talking to donors. He has a campaign team that's going to be set up as well. So now he's really starting to ramp up into 2024. The big issue he's going to have as he seeks re-election is 2020 was really about, and you talked about this earlier, a referendum on former President Donald Trump. And at the moment, they are trying to, again, make 2024 about President Donald Trump. But at this time, he's also going to have to defend his last 4 years. And that's where the Republicans are going to want to strike attacks, most notably on the economy.
Well, let's talk about his age, because it keeps coming up. 70% of all Americans, according to this poll from NBC News, including 51% of Democrats, don't want Biden to run for president in 2024. The major reason, nearly half of those respondents cited his age as a major reason. MH, this has been somewhat frustrating for me because people describe this as the elephant in the room. And we put all 80-year-olds of the country into one bucket and say that they're not capable of doing a job. And I think actually the real elephant in the room is not that the president is 80 and will be 86 at the end of his second term. It's whether you believe he is someone at 80 that does not have the capacity to do this job. Because that's not true of everyone in older age. Is it true of this individual?
Well, listen, he has had a very difficult in terms of traveling schedule over the past 2 years of his presidency. This is someone who has had huge trips around the world and is able to land and go into these difficult meetings. And at the moment, when you talk to people on his team and you see the president out and about and talks to reporters, his age has not hindered him. We should also know in that NBC poll, Jonathan, a lot of people also don't want to see just a rematch in general of the former president, who is only 4 years younger than the current president. So President Donald Trump and President Biden both in the older age. And a lot of people are just, the whispers are about fresh faces, really, for both parties. But at the moment, that is going to be something that Biden says, I was able to do it. I proved myself, and watch me, I'll do it again. Age, he understands, is a factor, but he says he's healthy right now and he's ready to take on 2024.
And Kelly, before we deal with 2024, we've got to deal with this year before we get to next year. The debt ceiling debate, the kind of economy that we'll be talking about through the campaign and into next year. Where are we on that front now, Kayleigh?
Well, of course, the X date is drawing closer by the day. Now, in D.C. today, later on this afternoon, Speaker McCarthy's $1.5 trillion debt ceiling raise proposal will go to the Rules Committee. That's not going to see any changes to the bill. It will just set the floor procedures, because our reporting here at Bloomberg indicates that both Speaker McCarthy and his top lieutenants have told their fellow Republicans this bill will go to the floor as is. They are not going to change it, despite different members of the Republican caucus raising issues on things like the ethanol tax credits, as well as work requirements for social programs. So there is still a question as to whether Speaker McCarthy can get the 218 votes that he needs. But Henrietta Trey's over at Veda Partners this morning says that actually the timing of Biden's announcement may be working in McCarthy's favor here. She wrote, the tone in D.C. is increasingly optimistic that McCarthy will get this bill passed, because McCarthy is corralling his members this morning around Biden's re-election announcement. It is now their base case that this thing will go through. Then it becomes a question of whether or not the White House and Democrats are going to be open with negotiating with McCarthy should he get the votes to pass his bill.
Hey, Kayleigh, thank you. Alongside Anne-Marie, the update from Washington, D.C. The broader market right now, 23 minutes into the session, we're negative 0.6% on the S&P. Coming up very shortly, your trading diary. Before we get there, First Republic right now in early trading, trying to bounce down 29% lower, record low. Almost 26 minutes into the session, we are negative 0.6% on the S&P and the Nasdaq. A similar move on the Russell of small caps struggling. Your trading diary looks like this. Alphabet and Microsoft earnings at the close, followed by Meta on Wednesday, Amazon Thursday, plus US GDP and another round of jobless claims onto Friday. PCE inflation, UMich consumer sentiment and personal income and spending data to round out the week. That rounds out the morning for me. Thank you for choosing Bloomberg TV. As always, good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.